Hi there. Thanks for tuning in. Today, I'm going to be doing a valuation and comparison between Bumble Inc. and Match Group. So let's just get right started. So the difference between Bumble and Match Group, Bumble basically owns Bumble and I think maybe one or two more dating related apps, while Match Group is a giant here. So we're talking two different companies with two different market caps and two different levels of maturity. Match Group owns stuff like Match.com, OkCupid, Tinder, Hinge, which is the newest growth generator of Match Group, right? So there are two different companies at two different stages. Bumble is a little younger. Match Group has been there for a long, long time, although some of their apps have not been there for a long, long time. And recently they've had different performances. So here I want to get started with just numbers, right? So you'll see that return on assets, return on equities, return on investments are all negative for Bumble. This is not the case for Match Group. However, when you look at their gross margins, they're very similar, right? This makes sense. For a tech company, it doesn't necessarily cost you more to sell one more unit of an app, since an app, once you have it out and you download it, it's sort of free for the company, right? It may cost you marketing, which goes in your operating margin, but it may not cost you more input necessarily, more materials, right? So it makes sense that the gross margins are similar. However, when you look at operating margins and then profit margins, this all goes negative for Bumble, while Match Group is a profitable company, right? So they're at different stages right now, but profitability is lost for Bumble at the level of operating margins simply. And Match, as you'll see lately, this is an update from Q3 2023, has less payers, right? Their payers are actually decreasing. There's less paying users in many places. And this would be this column right here, just so we know how to read it correctly. This column right here is 2021, and this column right here would be 2022, right? So it went from in total payers in 2021, 16,000, or sorry, Q3 2022, it was 16,548 total payers to 15,712 total payers, right? So it actually, and this is millions, so it went down significantly, right? And that's important. However, the revenue per payer, right, is actually went up from $16.02 per user to $18.39 per user or per payer. So that is actually a very significant increase, right? So that's very interesting because Match's trend is different. And if this concerns you, well, you have to look at the nuance of each payer is paying a good chunk more, 15% more, right? So even if they lose a few payers, as long as they can keep that going, that's not a bad thing, right? And if this is temporary, the loss of payers, it's also important, right? Now, Bumble, on the other hand, has sort of the opposite going on, right? So the paying users are increasing. They have increased basically 25% quarter over quarter, but the average revenue per paying user has basically decreased by 2% or stayed flat. Notice that it is much larger than here. The average revenue or the total revenue per paying user is $18.39. For Bumble, it's $28.38. However, it has not grown, and that's very, very important, right? So the devil's in the detail here. They're two different companies with two different metrics, right? And that's important to see. Now, if we look at the report for Match.com or Match Group, then we will see that they actually had an increase in revenue. As we just saw, this is because more users are paying more, even though the total number of paying users decreased, right? So their total revenue went up, their total revenue from Tinder went up, from Hinge went up, and from their evergreen and emerging apps, it did not go up. That makes sense, right? Less people are using OkCupid, more people are using Tinder and Hinge, right? This is not surprising. And Hinge is the growth catalyst here, for changing a total of 44% from 2022 to 2023, right? So that's very important. Now, the financial highlights for Bumble show that from Q3 2022 to this current quarter, right, they had an increase of 18% in revenue, an increase of 23% for the Bumble app revenue, increase in paying users, and increase in average revenue per paying user. However, by 2%, a very slight amount. However, their net earnings still went down, right? And That's very important to note, right? So that shows that there's some operational inefficiency there. And because the operating margins or the operating expenses was where Bumble lost a lot of that profit, right? It's very, very, very important to note that, because generally your operating margins or your operating expenses are your fixed costs, right? They're a little bit harder to get rid of, right? It's not just producing slightly less or maybe making your supply chain a little more efficient. It is people you've hired, right? You have to let them go. If you have to let them go, you have to give them severance packages, etc. So they're losing efficiency there, and net earnings are down, and that is important. That's actually huge, right? Now, here's another story for Match Group, right? Where we have the 3 months ended September 30 in 2022 and 2023, where revenue is up. The operating costs and expenses are up too, but not as much as revenue. So at the end of the day, your operating income is still up, right? In a 9-month period or a 3-month period, it does not matter, right? And the net earnings are up. So it's not only everything's going up, but margins are actually slightly improving, right? Now, the growth of Tinder, for example, might be slowing down, or if some of their legacy apps might be slowing down, but that's okay as long as the numbers keep going, and as long as Hinge, for example, keeps performing the way people are expecting it to perform, right? Now, there's also another way we can compare Match Group and Bumble Inc., right? And that's EV to EBITDA. So here, there's a pretty good look of just some internet companies compared to Match Group, right? Match Group has a market cap of $8 billion, and the trailing EV to EBITDA is 10.1 times. The forward is 17.6 times, right? This is compared to an industry median of 17.5 times and 18.2 times. So it's below those two metrics. Bumble, on the other hand, is at 24.7 times EV to EBITDA on every metric you see it. And also, it's interesting to note that its market cap is basically $2.7 billion, even though it is a much, much smaller company, right? Their total revenue in basically a single quarter, right, was 275 million for Bumble versus Match Group had 881 million, right? So yeah, I guess that about reflects the difference in the market cap, but it's just important to note that this is a much larger company, and in terms of EV to EBITDA, it's actually technically cheaper than Bumble, right? Free cash flow to equity can also be calculated for Bumble, and what you see is that once you subtract stock-based compensation from the cash from operations number that Bumble has, free cash flow to equity is not as consistent lately, right? So if you'll see, this cash from operations includes an item named stock-based compensation. However, stock-based compensation is an expense. It's a stock you're giving out to executives, to employees, etc. So you have to actually subtract that from cash from operations. So what I'm doing is I'm simply subtracting it in the last 5 years, subtracting capital expenditures, of course, because that's what they expend to keep the machinery running, to keep the lights on, etc. And then free cash flow to equity is what's left in hard cash money for Bumble, right? And as you'll see in 2018 and 2019, ton of free cash flow, right? 2020 to 2022, not so much, even in 2021 going negative, right? What does this coincide with? Well, it coincides with a little bit of exuberance and spending, of course. It coincides with more stock-based compensation. It coincides with them going public, right, as a company in 2021 and 22, right? That makes sense. They went public, so they're issuing a ton of stock for executives, employees, etc., right? And at the end of the day, it also shows us that as interest rates go down, or interest rates go up, rather, they can no longer borrow cheaply. They can no longer do a lot of the things they used to do here in 2018 and 2019. That's some of the pains of going public. That's some of the pains of higher interest rates for tech companies, right? Free cash flow to equity for Match Group is a different story. It's pretty consistent. It is down a little bit in 2022, right? Or significantly compared to the previous years. However, based on the results in the previous quarters, it seems 2022 seems to have been more of a blip than anything else, right? So here I'm simply grabbing a ratio of the free cash flow to equity over the revenues, right? It says net income here, ignore that, it should be revenues. And basically how much of the revenues are turned to free cash flow, right? And sure, also Match.com or Match Group had better numbers before, right? 51%, 40%, right? Nowadays it is less. Again, exuberant spending, more stock-based compensation sometimes, which is true. It has also been growing, right? And that is a mistake I made in my first valuation of Match Group, which I will link. But it's something that has to be accounted for, especially with tech companies that issue a ton of stock-based compensation, right? So you have to make sure to subtract this from the total free cash flow to see how much cash money they actually have left over, right? And anyways, I am taking that ratio of how much of the revenue gets turned to free cash flow, and my average for the last 5 years is 30%, right? With let's say 2022 being a little bit of an outlier. So I can do two different valuations here for Match Group. One, I'm going to grab a 23% free cash flow margin, essentially this number right here from 2021. So I'm saying it's going to recover compared to 2022, but not as much as the years before, right? So I'm going to do that. I'm grabbing numbers from Yahoo Finance on how much analysts think it's going to grow in terms of revenue for 2023 and 2024. I think it's about 7%. Then I'm going to grow it by 5% in 2025 and 2026. Then I'm going to give it a required rate of return of 11%. That's 1% more per year than the market. And then a perpetual growth rate of 2%, which is going to grow by 2% forever, which may be underrating the stock a little bit. It may be able to grow more than that, right? Especially because dating is an evergreen market. Everyone will always want to find a partner, right? And with that, divided by the total number of shares out, I get a fair value of equity of 35 cents or $35.21. However, once we subtract their net debt, the fair value is going to be $22.83. This is very different than the first time I valued Match Group, where I had it closer to about $31, $32. The reason why is because now I'm accounting for stock-based compensation. I'm subtracting it from the total free cash flow numbers. However, I can also try a different thing. If I'm saying here we had a 23% number just to be a little bit conservative, right? But what if we take this average of 30% of free cash flow being turned, or 30% of revenue being turned to free cash flow? Well, I did just that. And in that case, you will have, with the same numbers, 11% required rate of return, 2% perpetual growth rates, a value of $33.54 with the net debt included. Now, where's Match Group right now? Match Group is at $29.70 last time I looked at it. So that is below this number, but not this number with a 23% margin, right? So you are just going to have to see whether or not you believe this calculation, or you have your own, right? So it could be an interesting buying opportunity if you so desire, but it also is going to depend on a few things, right? Such as how much the margins recover by in terms of free cash flow. Now, there's time for nuance. So first of all, yes, I made a mistake in my last valuation by not accounting for stock-based compensation. That is something that I have to recognize and that I have to account for in future valuations, right? Especially for companies that have anything to do with tech, apps, etc., but many other companies, right? This is an expense, so we have to expense it out. Now, accounting for this shows severe weakness in Bumble's overall free cash flow to the point that I can't really do a discounted cash flow model because they don't have consistently positive free cash flow. And it paints a different picture for Match Group. Ultimately, valuation for Match Group will depend on margins recovering to what they used to be, right? And by how much. If they recover by a ton, then maybe it is undervalued compared to the current price. Meanwhile, valuation for Bumble will depend on being able to be profitable in the first place, right? If they can increase that net income, then that free cash flow will be higher, and then the stock-based compensation expense won't be as much, and then they'll have positive free cash flow again. In other words, Bumble is way higher risk. Match is much lower risk. Basically, Bumble, you're buying into a company that's not profitable. You're maybe estimating, you're going to see if maybe they become profitable in the future. I hope so. I wish Bumble became profitable. If they become profitable by this much, maybe it goes up by this much. That's a lot of maybes, right? Match, we know it's already profitable. We know it's on the road to recovery. How much would it recover by? That's the question, and that's unclear still. However, that to me is much lower risk than Bumble. Now, profitability matters, right? And it's at every level, right? The gross profits, the operating margins, as we saw, the operating margins for Bumble are very, very different than that of Match Group. And it matters at the bottom line, right? The net income and at the free cash flow level. So profitability matters, and we have to take a look at it. So with that said, thank you so much for watching this video. If you want me to look at any other stocks or businesses, please feel free to comment down below. With that said, I thank you so much for watching once again, and I hope you have a great rest of your day.